This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with Manus Clancy and Diane Crocker. In today's episode, we're diving into CMBS lending. Today's guest is Shlomo Chopp, founder and managing partner of Case Property Services. With over 20 years of experience, Shlomo is a go-to expert in distressed real estate workouts, advising borrowers on navigating CMBS challenges. We're going to turn the lens with Shlomo's help on the bond investor's point of view. What should CMBS credit analysts, traders, and investors know when things go south? Welcome, Shlomo.
Thank you, Martha. Thank you for having me.
And I probably should mention quickly, you're also an investor, an inventor, a bit of a social media celeb. So we're excited about some of the things you're going to walk us through today. Let's start with setting the stage. What kind of borrower typically chooses CMBS over banks, insurance companies, or private lenders?
I think in today's market, there are two types of borrowers, but let's just talk generally. CMBS is a highly structured product, which means that it comes with a lot of rules and strings attached. So typically you are looking at a borrower that is looking for maximum proceeds, a minimum risk outside the property, and has a really solid infrastructure to stay within the guidelines of the CMBS documents, which can be perplexing to certain borrowers. Today, in today's market, is a whole new set of borrowers, which are borrowers that don't have any other options on the table. Borrowers that may not be suitable for CMBS, but they find that CMBS gives them more proceeds. And not to go down a rabbit hole, but the reason for that is that CMBS, as opposed to a bank, the underwriting is different. If I'm going to borrow from a bank is going to give me a loan based on the secure releases and secure income at my property. A CMBS lender may actually give you more than that and take greater risk, but they will have their hands all over your cash flow on a day-to-day basis. And the second the business plan doesn't go as you proposed it would go or believed it would go at the time of origination, or the originating lender, CMBS lender, thought it would go, then they start taking your cash flow as risk, as almost like a credit enhancement against future issues. For example, a leasing requirement or not enough money coming in to pay debt service. So there are different reserves, if you will, that get filled up. So the short answer is, used to be owners of stable assets with great infrastructure. Today, a lot of people that can find financing elsewhere, and CMBS lenders are okay with that additional risk because they control the cash flow.
You made a remark a moment ago about, if I'm going to paraphrase this, entanglement. So I think what you're talking about there is the recourse, non-recourse element. Most bank loans, recourse, CMBS, non-recourse. Is that a big motivating factor for people that go into CMBS loans?
It's a very big motivating factor, but they need to be careful. The extra 5 to 10% you may get with a CMBS loan, read those recourse paragraphs or the recourse language very carefully. So here's an interesting thing that people don't realize. Non-recourse CMBS loans actually have a full unconditional guarantee from the borrower. There is, however, a paragraph called exculpation paragraph that essentially says, provided you don't violate a series of, we call them carve-outs or bad boy acts, then we won't go after you for a monetary judgment. But we will pursue you for a judgment of foreclosure to collect our collateral. So what those sentences say are extremely important. And if you don't read it properly, you walked into a recourse loan that has way more restrictions than your average bank recourse loan would have.
So I want to stick on that point for just a moment, or maybe it's a slight bit of a tangent here, but when you write on LinkedIn or when you write on Twitter, you said before that you hear from the borrower periodically that when they deal with a bank, they have a relationship, they value that relationship, they believe that that relationship will, for lack of a better term, save them. Whereas in the CMBS market, they're dealing with somebody who's faceless to begin with, right? Until they go through the process, they don't really know the banker. There's no relationship there. But you've said that banking relationship isn't worth a whole lot. Can you get into that a little bit?
Yes, I'll go even further to say that in the events of true distress, it may be easier to work out a CMBS loan than a bank loan. And the reason for that is as follows. Manus, let's say you owe my dad $1 million and you and I golf together every single day. What are the odds I'm going to tell my dad to walk away from those $1 million just because we're really close? I mean, we've had you over for dinner. We've had, you've been by family weddings and but you owe the $1 million, right? The relationship is good to forestall smaller issues. The relationship is good to stop small issues from turning into big issues. But the reality is, if you want to ask your lender counterparty for a significant write-down, it's probably best done to an impersonal bondholder with whom you don't have a one-on-one relationship that basically baked in that write-down a certain extent of it, or during some type of a trade baked in that write-down when one bondholder bought it from another bondholder. That's going to be way easier. And part of the reason it's going to be easier, aside from the personalities, is because the underlying documents for the CMBS trust actually go through a series of steps, a process for dealing with the stress. And it becomes a very, a numbers game. What do I get if I give this guy his discount, air quotes? And what do I get if I foreclose on him and sell the property as REO in the market? So the point twofold is that relationships are great until I really come after you with something you don't like. Then all of a sudden we don't have a relationship anymore. I mean, people get divorced. At one point they were in love, right? And it's the second thing is if you're going to deal with a potential breakup, you'd rather it be something that's documented, something that's been explored, something that's been accounted for, that you could then walk through the doors and the pathway that's been laid out.
CMBS involves borrowers, it involves servicers, it involves layered investors. Do multiple classes and interests complicate workouts or does it delay them?
The nature of a CMBS trust is that there are multiple classes. But if you think of a CMBS trust as a structured syndication, right? If let's say I am Wachovia Bank, okay, and I wanted to go out there and make a $500 million loan. Typically, I, as the lead bank, would maybe take $250 of that, and then I'd then go sell off the other $250 to a couple of other banks. Then there'd be an intercreditor agreement and a co-lender agreement that would dictate how they would tackle any issues that may arise. CMBS trusts are essentially the same thing, except there's a lot more security for one lender versus another. So, for example, if in the case of the example that I gave, Wachovia may have certain rights and they'd have to go out there and get approvals from their other lenders, co-lenders, for taking certain actions. In a CMBS trust, let's just assume Wachovia says, I'll take the first $250 in losses if there's a loss. And you $250 above me, you don't have to worry about it. So I'm going to go out there and I'm just going to resolve it however I want. And you guys don't worry about it. We're good. And the other two lenders say to themselves, I don't see how the losses ever eclipse 250. We're good. No problem. You got all the rights, Wachovia. Go do what you need to do. But then the market hits a downturn. All of a sudden, that 250 potential loss seems more realistic. And it may even hit 270, depending on how scrupulous Wachovia is and how things work out with the borrower. That's what CMBS is. You end up with a bunch of different bondholders or tranches of bondholders, and you have one decision-making or if you will, controlling tranche / bondholder, the guy that owns 50% of that tranche, that gets to make the call on how things play out. Now, if a upper bondholder that is not in a first loss position, but actually has a credit enhancement, if you will, or credit support by having that 250 under them, decides that the guy at the bottom is about to be wiped out, but he's about to make a decision that's going to affect me. Then they send what's called, I don't know, love letters. I don't know I forgot the exact term, but it becomes what's called tranche warfare. And they could devolve sometimes into litigation. And you end up with two tranches, two bondholders fighting against each other and threatening the special servicer who's following the direction typically, or at least seeking consent of the first position loss, the Wachovia Bank, if you will, and say, if you do this, we're going to come after you. That could slow things down. I've had workouts that I'm working on now that, we were going to go to a deal and somebody got upset and the servicer didn't want to risk it. And it's just dragging out and it's a process. So anytime you have more than one person making a decision, it becomes complicated, but there's a process in place. And the question then becomes really of settling the argument, because no one wants to leave it up to a judge or even in some cases, God forbid, a jury to make a decision on something this complex.
Let's pull back the lens a little bit on what you were saying there. I want to get into some real meaty stuff here. You mentioned people at the top of the stack that when things are good, when the loan is first made, they're okay assigning their rights away because they largely think that the worst case scenario will never happen. But worst case scenarios do happen, and eventually single A, double A, triple A bonds can get threatened. You're in the weeds every day with documents. You're in the weeds every day with lease negotiations, renewals, maturity dates coming up. If you're a triple A buyer that, for lack of a better word, is on autopilot, what would you advise that triple A buyer to look at to avoid something where they are later coming into tranche warfare? What are some of the clues out there that might prevent this sneaking up on somebody, not necessarily AAA, but somebody above the first loss holder?
Yes. I think, first of all, as you mentioned, the AAA, as they call them, the super seniors, super duper seniors, or whatever the cliche they have to call them, typically they're in a decent position. There is the matter of duration, essentially, like how long I have my money out there and at what rate I have my money out there. So, for example, if I'm a AAA buyer and I have a 2% yield and I bought it for 90 cents on the dollar and I expected to get paid off and the payoff doesn't happen because the borrower got an extension, that affects me. But one could argue you have a little less of a yield, but, at least you're sort of made whole, although that's never true in bond land because you're buying with the yield baked in. But the second part of your question you asked, man, is some guys in the middle of the stack, if you will, that they neither have control nor do they have AAA status, right? Their bonds are maybe at the lower end of the credit spectrum, the triple Bs, or just below it. And these tranches often trade. And I think the most important thing that most of these traders and bondholders need to realize is that a property goes from money good to money bad very quickly. And often the lender taking over from a borrower that's deemed to be not the greatest borrower in the world may not solve the problem. I think we've been spoiled in some respects. Even the GFC, there were a lot of losses for sure, but we rebounded pretty quickly. And even now, the pace of losses in CMBS land take much longer than real estate land. And that's because you're up the stack. You have the buffer of, let's say it's 100% LTV is the total value. With 100% value, you have 70% LTV. You got a 30% buffer, right? Furthermore, there may be money in reserves that you could eat from while money maybe stagnates at the property. But a disincentivized borrower or a lender that maybe is not a top tier operator will find themselves impaired quickly, and therefore the property will deteriorate. And once a property starts going downhill, it's much harder to rebuild than to demolish, right? All it does to demolish, you take a huge crane with this huge ball, you go boom, you knock down a building, you put some TNT and you implode the building. When in reality, to build it up from scratch, you got to build a foundation. You got to actually, come with a plan, and the whole thing is takes way longer, as everyone knows. So I think the biggest challenge that I see is that I've seen a lot of bonds that should be trading for less, trading for more. And that's because of one very simple fact. I think it's for borrowers need to understand this. The guys that buy CMBS at the super senior level, meaning at the AAAs, the top of the stack, they're investors. They're in it to hold, have a good day, right? The lower you get down the stack, you're dealing with bond traders. The question is, if I bought this bond, how much cash flow could I squeeze out before it goes to hell? That's really what it comes down to. And the more down the stack you go, the more close to hell your part of thinking actually enters into the equation. So borrowers look at operating properties, and borrowers realize they need momentum. Lenders are like, listen, in a worst case scenario, it's worth X, or let's call it X minus 20%, and therefore I'm good. But that ship sinks very, very quickly. And that's a huge challenge. And it's often not underwritten, and often it's pushed too far, in my opinion, by either CCRs, controlling class certificate holders, or special servicers. And borrowers are not given enough credit for their expertise.
It's funny, as I hear you talking about this, I keep getting the image of Dante's Inferno, right? Isn't that like is it the 7 layers of hell or the 12 layers of hell? I keep thinking there's a book out there called Shlomo's Inferno, right? Where you go from the AAA down to the single A, down to the unrated bond. And the closer you go down that stack, the closer you are to true hell.
Well, but Manus, I got to tell you, I got to interrupt you, okay? Because just like they make mistakes on the upside, they make mistakes on the downside. And I found some really cool diamonds in the rough over time to invest in, where the market has discounted it. Oh, office is bad, right? And then you're looking like, this is pristine and the basis is great. I'm perfect, right? So the good thing about bad things is when everyone follows the leader, and you could actually find the things that shouldn't have followed leaders. So I just want to make sure Shlomo's Inferno not coming to a bookstore near you anytime soon.
I'm going to bring up 2 very high profile scenarios. One which the losses really moved up the stack very, very far, and one which losses are looming and will hit people very far up the stack. The first one, 1740 Broadway in Manhattan. L Brands was a big tenant. The property was once worth $600 million, got sold for under $200 million. Big losses, not just to the first loss holder, but up the stack. We have one looming right now, the Market Center out in San Francisco. Similar type of story, right? Tenants don't renew, the market's weak, vacancies are high. Eventually, these are going to be losses that could threaten the AAA class in that issue as well. Does a AAA buyer normally find this out from the Wall Street Journal while they're riding Metro North? Or is there a way where guys are on top of this before something this cataclysmic takes place, right? Is there a way to kind of sidestep this in your world?
I think there's too much reliance on yesterday's value, right? Properties don't get reappraised until they're 60 days plus past default. So it's really difficult to figure out that you have a problem unless you're paying attention to what you own. And it goes, I tell people in real estate all the time, there's no such thing as passive income, only passive losses. And it's the same thing. If you're passive with your investments, it's going to hit you, and it's going to be a problem. I would throw another one in, which is 1407 Broadway, which I think 1740 Broadway was a good financing at the time it was made, right? COVID came, but I mean, from what I understand, Blackstone did everything right. They did a great job marketing the building. They added amenities to the building. It's just a matter of, COVID. And we looked at it from a residential conversion perspective, and we did not like it. The guy that's doing it right now is supposed to be real talented, and I'm sure he'll do very well with it. I just couldn't make the numbers work. I'm not familiar with San Francisco one at the moment. I'll tell you, 1407 Broadway is one where I don't understand it. It had a ground lease that had bumps built in. It just is. I just don't see the thought process in the financing to begin with, right? Almost similar to, we saw with, with the Chrysler buildings. Like I don't understand how you buy it at that number with that type of a risk attached to it. So I think too often there is the thrill of the deal that comes into play. I think often those are issues. But back to your question on the AAAs, they never thought they'd get hit. Like who would ever think, right? And that's sort of some of the calculus that gets put in place. And especially when you're higher up in the stack, you get a lot of the pricing, the pricing services that give you a number. And you look at it and you go, why is that priced at that number? Like I have bonds, you look at it and, on the statement, it says the value is X. I'm like, no, it's not, but okay, you want to put it there, you want to mark it there, no problem. Have a good day. So I think when you're not paying attention, when you're not on top of things, it becomes a challenge and it could surprise you to the negative sometimes. And then if you're paying attention, you'll surprise the market to the positive.
All right, Shlomo, let's go into the weeds here. So for triple B or below bondholders, if they're facing potential large losses or modifications, what should they be analyzing? What are some red flags that you see?
Yeah, I think by the time you're triple B and below, below triple B, and you're looking at some losses, you're too late. Because the way you know that there's losses is because you see there's some distress at the property. You see the appraisal came in too low. You need to be out ahead of it. Anyone who's going to play in that lower BP space is going to have to literally act as a real estate participant. You're going to have relationships with every single brokerage house. You should be walking by your properties. You should see what's going on. You should be talking to people in real estate. You should be aligning yourself with these people so that you can see a few steps ahead. It's like, oh, John Doe, how's his management company doing, right? You want to know the answer to that question, right? Is he having issues there? How's the property leasing? Which tenants in the market? Where are they going? What part of town are they going to? What's going on with the market generally? There's a lot of work that needs to be done. It's funny, you think a CMBS trader should not be like a stock day trader sitting at his kitchen table, sort of, trading, IBM and going in and out. There's so much diligence that needs to go into this. It requires a lot of work, and there are services that help you with it, but there's nothing better than having conversations in the market, because the average real estate broker probably knows more about your risk than the guy that's trading the asset with you. And if you could stay on top of that, you could probably be out ahead of certain things and know certain information. It's not material, non-public information. It's public. It's just not spoken about in the bond market. It's spoken about in the real estate market. And that's an interesting thing. And I'm going to go a step further and say, CMBS bonds, the attractiveness of this is that it's like corporate bonds, but its exposure is to commercial real estate, which to a certain extent is an indirect exposure to corporations because they're the ultimate tenants that are leasing from you, other than residential, multifamily, putting that aside. So you're getting that level of exposure. But unlike a corporation where you're looking at its position within a niche market and its position in how much of the market it captures, how much sales it does, all that, you're actually competing very heavily in a very wide market that's constantly changing and constantly moving. And heck, if the municipality decides to elect assessor like in Chicago that's going to tax the properties like crazy, you'll end up with a property that's worth way less than it did, than it was a year ago. And that actually, the operational challenges of a property could flow through to you, but you'll never know it if you're not paying attention until it's too late. So the cognizant investor in CMBS, the investor that's paying attention, could be a few steps ahead and really on the ball, understand what's going to happen next if they just pay attention. And, for example, like the bond investor that lends to a widget company that makes sure to go to every widget conference to listen to every presentation on widgets. Heck, if the guy is lending to Simon Malls, he goes to ICSC and he listens to all the presentations about CAM reconciliation and sort of understands how the underlying numbers he's looking at actually come to be. If you do that, you have your competitive edge. And I think those that don't are unfortunately, coming up the rear in this long train of losses. So it becomes a real big issue.
You're really talking about two different types of risk, right? One is the likelihood of demand from tenants, right? Will the tenant come to this property? Will he renew? And will he renew at what price, right? So you're talking about market dynamics, how much supply and demand there is at the property level, among the tenant base, how much vacancy there is, how much absorption there is. But you're also talking about credit risk here, right? We've seen it a lot in retail where you've seen defaults hand over fist for the last 10 years with retailers. They say, oh, this property is 79% occupied, but if a big chunk of it is Joann Fabrics or a big chunk of it was Sears or somebody else that would eventually go into bankruptcy, you're kind of lost. So this is a long-winded way of me asking, there's a lot out there. How do you stay on top of it personally to make sure that you are the most informed you can be as you're advising your clients?
Well, the good news for me is that I don't have to trade CMBS, right? It's something that I do opportunistically. I don't have to typically focus on large pools of conduit loans that I have in my portfolio and keeping an eye on it because that would be very, let's say, costly and require a much bigger operation than I am on the investment side. But on the debt restructuring side, this is where, we are very differentiated compared to the rest of the market. So the rest of the market will pitch themselves in one of the following ways. We have great relationships. We understand CMBS. We demystify the CMBS process. We understand how to deal with your lender. And all those things appeal to different borrowers at different levels. Our biggest differentiating factor is less the talent, because a lot of these workout guys have the talent. It's more the heavy work and lifting. We'll do multiple leasing calls, try to understand what's going on. Like we had a call Friday, and the broker's talking about the market. It's a 25% vacancy market. And he had various ideas, but whatever the idea was, he wasn't getting over 25%. But the question is, okay, but we need to get over 25% for our loan. We need to bring up that income in order to make this work. Because even if I could restructure something with the lender is going to make me overpay the value. And I need to make it work. What are the various solutions we come up with to make it work? How do we do that? We dig in, we tour the properties, we tour the competitive properties, we understand where things are going within the individual market, and we guide the client to come up with ideas using their strengths, not ours, because we just ask the questions, and to propose something to the lender that puts them on better footing. So we actually dig in. We'll spend, in some instances, a couple of 100 hours of diligence just to figure out what is the pitch we're telling the lender other than like, it's bad. We all know it's bad. Great. You're in the second position or third position as the equity. The lender's in the first position. The prescribed remedies are the lender forecloses. Thank you. It's bad. It's our bad. Now we're happy to foreclose on you. And quite frankly, in CMBS loan, we prefer to foreclose. No one ever got fired for not modifying a loan. So what we do, we put in a lot of effort, and we constantly hear back from our clients, not the clients, from the lenders. Thank you so much for all the information you've provided. And trust me, it's not peachy. It's very much suits our clients' needs. It positions the problem as being a property problem, as being a market problem, and the solution as being a borrower solution. Every time, that's what it is. It just happens somewhere, the plot killer. That's what it works out every time. But there's something to it, and something the lender could say, okay, we now have a plan. The guy's ready to put up additional capital. He has a way to turn this thing around. Okay,
Shlomo, you're dealing with clients and helping them with this distress. So you have probably a very good view of where we are in the distress cycle. What's your point of view on that?
It's very hard to tell because it's very hard to tell how far we are and how far we still have to go. I could tell you that I am extremely busy, getting busier every day. Does that mean that the market's catching up to me? I'm catching up to the market? I don't know. I'm sitting in meetings with borrowers that look like the truck hit them in the face. I mean, there's no better way to describe it. LPs shouting at GPs, show me that account, show me that. I mean, it is rough. Okay. And the lenders haven't even gotten any hint of what's coming in some of these specific situations. It could be challenging. So the way I look at it is that there's a lot of issues. The way I see this is that I don't think they could be solved just with time alone in many instances. I think the market has moved on from a lot of office buildings. The market has moved on from some C malls. There are challenges with too many hotels developed in certain markets that still haven't recovered. But there are things that could change that can make an impact. So how much lower could we go? I mean, there are things that could take us even lower. And I don't think it's tariffs. I think tariffs is a nice macro argument. I don't think it's a micro argument. I think the guy that owns a shopping center in Tuscaloosa, Alabama, is not getting affected as much by tariffs as, I don't know, somebody that owns a huge portfolio of malls and 10% of his portfolio rolls every year. And he needs to retenant them, and he's going to see his stock price come down as a result of certain people pulling back from renewing. So the whole tariff discussion is a macro discussion, but for the average singular borrower that I work with on a single property on a one at a time basis, I don't see tariffs being an issue. So there's a long-winded way of saying it's so hard to tell. I don't know. And the best thing about being recorded is that when you make a really bad prediction, they could wave it back at you. Although it's never stopped anyone on some of these TV shows from saying a lot of interesting things. But nonetheless, I'm going to beg out of predicting where we are.
So, Shlomo, I want to ask you about retail. Not too long ago, a lot of people were kind of buying into the narrative that brick and mortar retail was a casualty of e-commerce, and the malls we shopped at were dinosaurs. But now we know post-COVID that this narrative was too simple, that retail's not dead and it's evolving. And you've been right at the forefront of that evolution. So I wanted you to kind of walk through your retail concept and what it means for the future of that sector.
Let's talk about e-commerce and retail as a whole and why I think e-commerce is, I don't know, all in from a business perspective might be the biggest fad I've seen ever. But then again, I haven't seen a lot of, I haven't been around for the tulip bulb disaster back in the day. So retail margins are, I don't know, 2 to 10% or so. Very, very thin, right? I got an idea. Let's smack on some more expenses to it, right? Let's add some shipping to it, some additional returns. Hey, let's get some warehousing on it in addition to our stores. And yeah, I mean, if we lose enough, we make up what we lose in profit, we'll make it up in volume. It just doesn't make sense. I mean, I'm still trying to get someone to explain to me how e-commerce for at least lower ticketed items makes sense. To me, it doesn't. But on the flip side, the consumer wants convenience. I think this concept of we can deliver things to your home is good until you start dealing with the issues. The biggest issue being the economic viability of it from a seller's perspective. So what if instead of delivering to someone's home from some warehouse that I had to keep enough product here in addition to some product in my store as well? So like if I run out of one place, I'm not going to have it. So I got to move it around. Or if I have too much, I got to put it on sale in another place. What if I just deliver it from the store? I mean, doesn't it seem I'm closest to the customer? Doesn't it make sense? That was really my thinking when everyone was screaming about e-commerce. Everyone was going like, oh, e-commerce is killing retail. Retail is dead. Stores are terrible. No, the assortment in stores were terrible. the product from the retail selling in stores were terrible. Innovation wasn't happening in stores. Why? Because the stores didn't have to innovate. They owned the customer. Innovation was happening online. Why? Because the guy that was innovating couldn't afford to open a store. So what if instead we delivered from store? But you may say, Shlomo, hold on one second. The guy can't open a store. How is he going to deliver from the store he can't open? So we got a solution. We got all these vacant big boxes out there. And in those vacant big boxes, you can store product. And if someone orders online, you could drop it into the mail or put it on a truck and deliver it to the guy's house. Also, if they come to store and it's not on the shelf, instead of telling them, oh, thank you so much for taking the half hour to visit our store, those shoes you like, we don't have it in your size, and you don't know whether if we had it in your size, it would even fit, but let's put that aside. We could ship it to your house. You'll have it in 2 days. Oh, and if you don't like it, you could always find a mailbox a half a mile from your house, drop it into and send it back to us. How about instead of that, you say, hold on one second, be right there. You beckon from the warehouse, and in I don't know, 2 minutes, it's there. What if you had a way to combine online and offline retail, because it never should have been separate to begin with? Now there's an opportunity to step in and acquire malls at the right price and to add this micro-fulfillment where essentially out of a 20,000, 30,000 square foot space, we could probably fulfill on an annual basis about $900 million worth of product. Probably it would be too much traffic to get the product out the door out of a smaller space. It also enables a retailer to have a smaller store. If a retailer is a smaller store but access to more product and assortment, then two things happen. First off, the customer has a better experience in the store. There's more product to sell to them. They could try on. They could decide they don't want it. They could exchange in store and the product's all on hand. But with less space, you pay less rent, even if I raise the rent on you, which I could now because he's selling more product. And because there's less rent and I'm selling from a fulfillment center that, by the way, you'd anyways pay rent for if you fulfilled via e-commerce, you put those pieces together and I could charge higher rents out of a store. My shopping centers are worth more. E-commerce fulfillment distributions, probably worth less, but that's fine. But shopping centers go up in value. And if I happen to own the shopping centers due to a patent, that's great. I'm not a logistics guy. I'm a shopping center or a real estate guy. And that's my primary focus over here. But there's tremendous opportunity to unlock potential, not only in NOI and value, but also in a totally different business that can rival, quite frankly, the Amazons and the Walmarts of the world.
I love the idea. I really think that you might be onto something here. I'd love to see somebody, either yourself or somebody else, take this on. I'd like to see this be kind of a FedEx-like experiment, right? Nobody thought that you could deliver things overnight cheaply 40 years ago, 50 years ago, and it became one of the great investments of the world. So, but I do think, Shlomo, you're underselling yourself. You're a real estate guy. I think you're a Renaissance guy. We've said you could be an author. You could be a professor. We already know you're an inventor, right? You could be a lawyer with your encyclopedic knowledge of pooling and servicing agreements. The true Renaissance man of 2025.
Mattis, if I was Julius Caesar, you would have been the trumpeter.
I love that. Even though I don't have a hint of musical ability, I would certainly enjoy the role.
Yeah, although I prefer that I would not be him, because after all, his buddy turned on him and it was like, it was rough, that whole story.
The downside.
I'd have
Yes.
your back, Shlomo.
Thank you.
Well, with that, we will close. Thank you, Shlomo, for joining us today on the CRE Weekly Digest. Thanks to our producer, Josh Bruning. Please join us every week as our Lightbox team shares CRE news and data in context. You can listen and subscribe on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.